Hello, this is Rich Canlione coming to you from the CME Group trading floor, and the segment today is going to be called Shrugging It Off. Obviously, with respect to the U.S. equity markets and the equity markets overall, it appears that we're shrugging off the geopolitical risk, and we've put that on the back burner. Geopolitical risk being, of course, the short-term price disruption that we've experienced in crude and gas price stability, and ultimately the market's initial perception was that that could have been short-term disruption to world and U.S. economic growth. That's on the back burner by all considerations, given that they've stepped up production there, and the assignment from NATO is that they're beginning to take action there. So all that aside, geopolitical risk premium is beginning to come out of the market, and that's why you're seeing a continued rally in world equity markets, and particularly in the U.S. And again, given that the underlying economic data in the U.S. is still relatively impressive. As an example, we saw mortgage applications this morning that were up 15.5%, much more than survey. Wholesale inventories better than 1%. That was in line with surveys. However, wholesale sales were up 3.4%. So having said all that, the market is actually poised to have another leg up in this rally. Just to give you some levels, on the bond side as an example, because I know some of you traders out there, day traders, institutional traders and the like to look at bond levels as well. We have some strong double bottoms in the bond, 118.03, 1805 area. That's a large double bottom. And you also have tops in that market as well in the futures, 119.13, 119.16. That brings us to the S&Ps. One of the major things that we like to look at in the S&Ps is the 8-week moving average. 1316.5 is the 8-week moving average. You want to get weekly closes over that, and we're beginning to sustain that even more and actually gain momentum. We're picking up open interest as we close up above that. Downside levels are a little deeper than we want to really look at, but what you'd have to do is you'd have to go through the month low, March low, which is 1296 even, 1296.30. Personally, I don't think we're going to see that. I think the expiration leg is going to take us back and retest the March highs, which are in fact 1336.30 area, 1334 area. All indications, again, geopolitical risk being put to the side. Mortgage apps, underlying economic data show strength. So I think it would be prudent to believe that there's going to be another leg up in the market and have another leg up into the rally that will retest those double tops in the 36s. All righty? Thank you. This is Rich Canlione signing off.